Good morning and welcome back. My name is Monique Ward and I'll be taking you through Unit Standard 252040. The Unit Standard title is Manage the Finances of a Unit. The specific outcomes of the Unit Standard are demonstrate an understanding of the key concepts of managerial finance, interpret financial statements, describe and prepare financial forecasts, draft budgets according to the operational plan of the unit, supervise financial management of a unit against given requirements. The key concepts of an accounting finance is usually your accounting cycle. The financial accounting cycle is the recording of all business transactions so that management can take that as useful information to do budgeting and forecasting later. The normal financial statements of a business comprises of an income statement, a balance sheet, and a cash flow statement. Let's have a look at a typical accounting cycle online now. Accounting cycle starts with source transactions, which are your normal receipts, check counterfoils, entries on a bank statement. These are then taken through into your journal entries where you capture cash payments journals, cash receipts journals, etc. They then form part of your ledger accounts, which is also commonly known as T accounts because they take the form of a T. These balances in the ledger then make up your trial balance, and your trial balance is then used to derive your income statement and balance sheet. A typical income statement comprises of all your income and expenses for a given period, which is usually 12 months. The balance sheet, on the other hand, comprises of all your assets and liabilities for a given period. Assets can usually be fixed or current. For example, a fixed asset has a long-term life. For example, when you buy a vehicle or a property or computer equipment, these are known as fixed assets. Current assets, on the other hand, are your stock, debtors, cash on hand in your bank account. These have a short-term life because they should be revolved. So these are known as current assets. Liabilities also have a long-term or a short-term life. Long-term liabilities are your mortgage bond or a vehicle loan. These are usually anything between 2 to 3 to 20 years. Long-term liabilities. Your current liabilities are your short-term liabilities. For example, a bank overdraft or your suppliers that you owe money to or your VAT that you need to pay SARS. This is usually less than 1 year. The next concept we're going to look at is budgeting and forecasting. A company has to plan with a good forecast, which in turn becomes your budget at the end of the day. So a forecast is what you think is going to happen in the future, and then you transform that into a rand value, which would be your budget that you're going to try to stick to. A master budget is a plan of all your operational items and your financial items. Budgeting involves all the departments of a company. You have operations, marketing, sales, finance. All of these departments need to come up with their own budget plan, and then this forms part of the master plan. You must remember that a lot of departments are interlinked. For example, if your sales department sees a trend and they know that they are going to sell more items in the next couple of months, they need to inform finance and operations of this trend. Otherwise, finance may not have the necessary funds at their disposal to assist sales with meeting those targets. After all the departments have comprised their budgets, then the management need to review this and come up with the master plan that they will follow for the next 12 months. Another important concept in the accounting process is what we know as GAAP, Generally Accepted Accounting Practice. There are 4 very important concepts that you have to take into account. The first being consistency. Your valuation methods need to be consistent from year to year. For example, when you depreciate your vehicles, if you start with the cost method and you write off your vehicles over 5 years, the following year you may not change to the diminished method. You need to be consistent in your valuation methods. The second accounting concept is known as prudence. This is where profits are not realized or brought into your books until they have materialized. Prudence is being cautious, making sure that you do not account for something that hasn't happened where you could materially change your income or balance sheet. The third accounting principle is known as matching or accruals. This is where you must bring in any expenses that are related to the income you have earned in the period. That is why you often see in an income statement or in the balance sheet accrued expenses or accrued income. If you know that you have certain expenses that relate to income, you must bring them into the accounting period. The last accounting concept is a going concern concept. This means that everybody is under the assumption that the company will continue in the following year. This has an enormous effect on the valuation of your assets and liabilities.